Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So I've been investing my own personal money since around 2017, and over the past sort of 4 years, I have learned a lot of different things about investing from a lot of different people. But throughout that time period, there's really only been a handful of individuals that have really shaped my investing philosophy. We've got the likes of Charlie Munger, of Warren Buffett, of Phil Town, Monish Pabrai, Guy Spear, and there's certainly a longer list of people that I've learned bits and pieces from. But the real sort of initial framework really came from Charlie Munger and actually Phil Town. And in this video, I want to get back to some of the basics of my investing strategy. I think a lot of people tend to sort of dive into this rabbit hole of investing and over time just continue to make things more and more complicated. So in this video, we're gonna go right back to basics, start out with Charlie Munger's 4-step checklist, which I really first heard through Phil Town. Charlie Munger did an interview with the BBC a few years ago and basically summarized this 4-step checklist into about a minute or so long video. So in this video, we're going to analyze each of those 4 steps. I'm going to give you some of my experiences and some of my key tips with each of the things that Charlie Munger goes through. And I hope that it helps to sort of simplify this overall value investing framework for you to apply to your own investing. So with all that said, let's get straight into the video.
We have to deal in things that we're capable of understanding.
So tip number 1 from Charlie Munger is we have to deal in things that we are capable of understanding. And both Charlie Munger and Warren Buffett have several times said that they don't understand probably 95% of businesses in the stock market. So here you have these two absolute investment geniuses, and they basically have narrowed themselves down to only 1 in, say, every 20 companies in the stock market. So why is that? Why are they only investing in things that they are capable of understanding? Well, basically the strategy, which we'll get into much more detail on right throughout this video, for both Charlie Munger and Warren Buffett, is to buy businesses that are trading at less than what they describe as its intrinsic value. What that business is actually worth based on its cash flows, a rational price that a private business person might pay for that company. They're looking to buy businesses at much less than that intrinsic value sort of estimate. And that is why Charlie Munger and Warren Buffett have to deal in things that they are capable of understanding. They have to be able to arrive eventually at a decision on what they think the intrinsic value of a business is. And if you have no idea how this company works or what the products that business sells actually do, then the chances that you're going to be able to accurately arrive at that intrinsic value are dramatically diminished. So from this first step from Charlie Munger, that is where an investor really needs to take that information on board and develop what they would refer to as a circle of competence. A circle of competence is simply an area of industries and topics that you as an individual understand very well. And over time, that circle will naturally get larger. As you look into more companies, as you learn about new industries, the circle of competence that you have as an investor will get larger over time. But even factoring that in, you have to make sure that you stay within your circle. There are likely to be several businesses and industries that you understand very well when you first get started investing. Maybe you spend your own money with those businesses in everyday life, and those are the businesses that Charlie Munger really thinks you should focus on initially. Now, I also find it interesting the way that Charlie Munger actually phrases this. He doesn't say businesses that you understand, he says businesses that you are capable of understanding. And that means that over time you will learn about more businesses. There will be companies that you've never heard of that you can look into and relatively quickly understand their business model. An early example for this for me was something like the New Zealand King Salmon Company here in New Zealand. Now, I have a background in agriculture. More specifically, I'm generally dealing with sheep and beef and dairy farms here in New Zealand in my everyday job, and I really have no formal education in aquaculture and farming fish or anything like that. But when I first looked into the New Zealand King Salmon Company, and this is not a stock tip or saying you should go and invest in this company or anything, it's just an example. When I first looked into the New Zealand King Salmon Company, that was a business that made a lot of sense to me. A lot of the core philosophies on farming fish is very similar to farming farming animals on dry land. You have fish stocks, in this case salmon. You have a certain amount of feed that you can offer to those fish. Those fish then convert some of that feed at a certain rate into meat, the final product, and that product is sold at a certain market price. So the variables that really drive the production and profitability in aquaculture are very similar to a lot of the variables that you will see in animal agriculture. So although something like aquaculture wasn't initially in my circle of competence when I first heard of that particular company, it was a business that I was capable of understanding with a little bit of work.
And then once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage.
Once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage. That is checklist item number 2 for Charlie Munger, and that is something that is more generally referred to as a moat. Basically thinking of a business as a castle with some great economics in this case, and having to lay out a moat around that castle in order to protect the superior economics of that business. That is what Charlie Munger is referring to here. And eventually all of this sort of comes back around to the idea of trying to figure out what a business is fundamentally worth. Now, if you take the strategy of Charlie Munger and Warren Buffett, typically when they invest in a business, they're looking to ideally hold it forever. If you look through their portfolio at Berkshire Hathaway, you see businesses like American Express, like Coca-Cola, many of their private businesses like Geico or See's Candy or National Indemnity or Burlington Northern Santa Fe or Berkshire Hathaway Energy. The list goes on and on of all of these businesses that are basically going to be essentially permanent holdings for Berkshire Hathaway. So over time, in order for Berkshire to continue getting a good return, for Warren and Charlie and their shareholders to continue getting a good return, they have to be buying into businesses where they can really understand what the long-term economic performance is going to be. And they really don't achieve that by buying into businesses that don't have this durable competitive advantage that is sort of intrinsic to the business. So they can't do that by buying into a commodity company where profitability year to year fluctuates wildly. They have to buy into businesses that have some sort of advantage which allows them to earn superior profits over time, and also allows Charlie and Warren as investors to understand what those profits are likely to be out into the future. So if we take some of the examples in the Berkshire Hathaway portfolio itself, let's take Coca-Cola for example. Coca-Cola has a significant moat around their economic castle, and that moat is basically the Coca-Cola recipe and the Coca-Cola brand. Now both of those two things for Coca-Cola allow them to charge a substantial premium in the marketplace over any random sort of store brand or home brand type cola. When people go out and get that drink, they say I'm going to go get a Coke, they don't say I'm going to go get a cola. And people are willing to pay up a little bit and pay a premium for something that is Coca-Cola branded and something that they know what it's going to taste like over and above some store brand, budget brand that they've either never heard of or that they haven't had a good experience with in the past. And from an investment perspective, a product like Coca-Cola has a north of 100-year-long track record that Warren and Charlie were able to look at and figure out what they think the future economics are likely to be for that business. There's a lot of evidence in the past that suggests that people really like Coca-Cola and they're likely to be consuming a lot more of it out into the future. This is in the 1980s when Warren and Charlie were first looking into Coke. They're likely to be consuming a lot more of it into the future. They saw that the average price for Coca-Cola was going up over time, and they saw that the average number of units sold was also going up over time, and that had been a very long-term trend that had a long runway for continued growth out into the future. And of course, that long runway for continued growth and understanding the simple economics of a business like Coca-Cola really allowed Warren and Charlie to, again, make a good estimate of what they think the business is worth based off the cash flows it's likely to produce not only today, but 10 or 20 years into the future.
And then, of course, we would vastly prefer a management in place with a lot of integrity and talent.
Checklist item number 3 is that we would vastly prefer a management in place with a lot of integrity and talent. Now, this is a step in the checklist that has always interested me a lot in terms of how Charlie Munger has worded this step. Maybe it's just me overthinking it, maybe it's not. Charlie Munger tends to be very accurate and concise in how he speaks, so I'm going to take this as having some sort of underlying meaning where he says that he would vastly prefer to have good management. It's sort of not quite as solid a prerequisite to go into an investment as the other 3 items on the checklist, as the meaning or understanding the business and the moat and, the valuation, which we'll get to shortly. It's really one that he sort of takes a step back on and doesn't have quite as high conviction as he does with the other steps in this checklist. And that's really because both Warren Buffett and Charlie Munger try to buy into businesses that an idiot could run because one day an idiot will. And that is a quote that originally came from Peter Lynch, which I believe Warren Buffett has also used every now and again. And it basically goes back to the idea of trying to buy businesses with durable competitive advantages. If you could buy into a business like Coca-Cola, sure, Coca-Cola is going to do even better if they have a great management team, a great CEO, a great CFO, and so on. But that 100-year track record of success for Coca-Cola is going to be one that is very hard to damage, even if the CEO isn't the best manager on the planet. But nonetheless, even if you have a phenomenal business, you would of course prefer a good management team over a poor one. And the 2 really key criteria that Charlie Munger mentioned here were both integrity and talent. And when it comes to determining whether or not a CEO has integrity, I think the first thing that we have to look at is whether or not that particular CEO is honest about what's happening in the business. And although someone like Warren Buffett is really often thought of as, the world's greatest investor rather than, one of the world's best CEOs, he really is one of the world's best CEOs. He manages a monster business by the name of Berkshire Hathaway, and every year as the CEO of that company, he writes a letter to his shareholders, and he has a multi-hour long Q&A session with shareholders every single year as well. And Warren Buffett is phenomenal at conveying what is happening in his business at any given point in time, both the good, the bad, and the ugly. If you take his most recent 2021 shareholder letter, for example, he spent a lot of time talking about one of the big mistakes that he made with acquiring Precision Castparts, basically overpaying for the business, and it forced Berkshire to take something like an $11 billion write-down in their latest set of financial statements. And although Buffett has also had monster successes that massively outweigh that Precision Castparts acquisition over the past few years, his investment in Apple, for example, where he basically sort of 4x'd his money with tens of billions of dollars, he really didn't spend that much time talking about the huge home run he's had in Apple. He spends far more time talking about his mistakes, and he writes those letters and all of his sort of communications to shareholders in a way that is really simple to understand, even if you don't have a strong finance background. So if you're looking for someone at the top of the list in terms of integrity, it's certainly Warren Buffett for me, and those are a few of the sort of characteristics in management that I'm often looking for. Now, of course, we can't forget the second thing that Charlie mentioned when it comes to assessing management, and that is to look at the talent of the actual manager. Now, integrity is one thing, and being open about the business is fantastic, but you also have to have a manager in place that is actually really good at their job. And when it comes to looking at the talent of a particular manager, there are a few key areas that I tend to focus on. The first one is the actual returns that manager is making in the business. This might be looking at a metric like return on equity or return on invested capital. Basically, those are both metrics that look at what sort of return those managers are making on our money as investors that has been left within that particular business. And the short story here is that we want those numbers to be as high as possible. We obviously want to be generating the highest returns possible internally within the business. But those are things that are only in the control of the management team up until a certain point. Every now and again, you have a business which naturally earns very high returns on capital, or you have a business that earns naturally very low returns on capital and can be a more challenging business to manage. So simply looking at those numbers and saying, this one's higher than that company doesn't necessarily dictate the talent of the manager, but certainly that's one thing I look for. Arguably, a better way of looking at that is assessing both the return on equity and return on invested capital and kind of tracking that over a period of time. Maybe the CEO has only taken over in the last 3 or 4 years. How is that 3 or 4 years compared against, before that manager was there? Those are all key things that we can look at with the talent of that particular CEO. And I also like to pay particular attention to some of the risks that that particular manager is taking. And that really comes down to this idea of capital allocation. So when a business earns money, what are they doing with that cash? Or if the business is in a position where they need extra money in order to grow or complete some sort of project, what sort of methods are they using to get that capital into the business? Are they selling or issuing new shares? Are they borrowing money and taking on debt? Or are they doing something else to sort of infuse capital into the business, and what is their mindset behind that sort of debt? Now, a company that I believe has really good management, that is a good kind of case study in this example, is a business like Thor Industries. Now, this is a business that I have a personal shareholding in. Again, it's not a stock tip, but a couple of years ago, Thor Industries made a very big acquisition. For anyone that doesn't know, this is basically a RV or motorhome kind of company. They're one of the two main players in the industry, really. And a couple of years ago, they made a huge acquisition of the Erwin Group. And in order to do that, Thor Industries had to take on a significant amount of debt. And it's been really interesting to watch basically how they've treated that debt over the last 2 years or so since making that acquisition. And the main focus for Thor Industries, knowing and being aware of the fact that they are in quite a cyclical business that can go through many highs and many lows, Thor has chosen to aggressively pay down that debt in order to basically de-risk the balance sheet, de-risk the business, and make sure that they will never have any significant chance of going to zero. And you don't have to look particularly far to find businesses that are doing just about the exact opposite. Some of the companies that really struggled through the recent crisis, things like Carnival Cruise Lines, for example, were issuing a lot of shares and also taking on a lot of debt in order to try and survive. And it will be interesting to watch how those companies treat that debt and treat that basically dilution of their shareholders by selling shares out into the future as their business starts to recover.
And finally, no matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life.
And the fourth and final step on the checklist for Charlie Munger, no matter how wonderful the business, it's not worth an infinite price. So we have to have a price that makes sense and offers a margin of safety given the natural vicissitudes of life. So we've found a business that we understand, that is in our circle of competence, that has a moat, that has great management, and now we get to the final decision on whether this investment makes sense and is attractive based on its current market price. And there's really a couple of key ideas that I want to get across here. Now, the first key idea is that investing in a great business does not necessarily mean that that is going to be a great investment. Take an example like Microsoft. Now, Microsoft is a phenomenal business. If we look from the year 2000 basically through to about 2016, the stock price though for Microsoft basically went nowhere. And yet if you look at the underlying financials for the business of Microsoft, they grew their earnings every single year right through that period. So what happened? Well, basically investors overpaid for the company. They identified that Microsoft truly was and still is really a great business, yet the valuation that was paid for Microsoft during 2000, during the tech bubble, was just way higher than made any sense for that particular company. So it's really easy to turn a great business into a poor investment by overpaying. And that's what Charlie Munger means by saying, regardless of how good the business is, it's not worth an infinite price, and you have to have a price that makes sense and also offers a margin of safety. Now, a margin of safety is simply the idea of buying something for substantially less than you think it's worth. And that basically protects you from downside as an investor. If you buy into Microsoft, for example, and that business doesn't perform quite as well as you had initially hoped or expected, then you have paid a price that suggests those lower expectations, and you can still get away with making a good return even if the business doesn't have, blockbuster performance out into the future like you might have expected. Now, one of the things a margin of safety also does is it sets you up so that if the business does perform really well, you can actually make a much greater return than what the business does. So let's say, for example, you buy a business with a PE ratio of 10, a business that earns, say, $1 a share and is trading at $10 per share. It's trading at 10 times their current profits. Now, if that business goes on to double its profitability and then earns $2 a share, you would expect that the share price would go to roughly $20 if it still had that 10 PE. Now, if that 10 PE was actually, relatively conservative and offered a good margin of safety, and that PE ratio actually goes up over time to say 20, you've now actually dramatically increased your return as an investor. So you've gotten a double out of the underlying business performance, but you've also gotten a double in that PE ratio through multiple expansion. And that turns your investment that would have otherwise been a double into a 4x. You've gone from $10 a share to $40 a share by getting a double in the business and then a double again in the multiple that's put onto that company. And that's really been the recipe for success for a lot of these great investors like Warren Buffett and Charlie Munger. They've identified great businesses that meet the first 3 criteria on this particular checklist, and they've been able to buy them at attractive prices that give a margin of safety. Now, I do have a couple of videos on valuation and how to calculate intrinsic value on this channel. There are a couple of the more popular videos on the overall YouTube channel, so I will leave links down in the description below to both of those videos if you want to check them out. So that's it from me today. I do hope you really enjoyed the video. If you did, please hit like and hit subscribe. I'm going to leave this full Charlie Munger clip at the end of the video so that you can hear Charlie Munger himself, telling you all about his particular checklist and telling you how it's a very simple set of ideas. If applied correctly, it can work very, very well. So that's it from me today, and I will see you in the next one.
We have to deal in things that we're capable of understanding, and then once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage. And then, of course, we would vastly prefer a management in place with a lot of integrity and talent. And finally, no matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life. That's a very simple set of ideas. And the reason that our ideas have not spread faster is they're too simple. The professional classes can't justify their existence if that's all they have to say. I mean, it's all so obvious and so simple. What would they have to do with the rest of the semester?